All right, good evening, everyone. We'll get started here. Thanks for coming out to the August Lancaster Real Estate Investment Meeting. A little bit of a lighter crowd tonight. I don't know if it's because of the summertime weather. I actually suspect it's because of the topic. It is honestly not the most exciting topic to talk about, but looks like the serious people are in the room tonight, and this is going to be a very fun, very worthwhile evening, and we're going to get to learn something that the people that didn't show up aren't going to learn. So, excuse me. So for those of you that don't know me, my name is Jake Byler. I have been a part of this meeting for quite a few years. Just simply a place for people to get together, share ideas, learn from each other, network, collaborate. It has been a lot of fun for me. I've said this many times. Groups like this have had probably the biggest impact of anything that I can measure since I started investing in real estate 15 years ago. Just consistently going to groups like this have had, as far as I can tell, the single biggest impact of anything else I've done is going to free meetings. So thanks for coming out. As you know, our meetings are primarily paid for by sponsors. Our 2024 sponsors are John Lapp with Providence Abstracting Company. Ben Yoash, he's a local realtor. We're going to get to hear from him in a little bit. Molly from Lanka Federal Credit Union. Jeff Moeller, he's one of our board members. He does some private lending. Joe Liofsky, Compass Property Management, also one of our board members. And Dave Wolf from Principal Mortgage Group. They are the people that pay the room rental each evening, so we're grateful for their support. So yeah, one thing we like to throw in here and there is just some different tidbits, this and that, at the beginning of the meeting sometimes, before we get into a main topic. So Ben Yoash is going to share just briefly on usually what we call it is some sort of a market update or news or something. And he's at a little bit of a disadvantage tonight because he had a little less time to study and figure out what he wants to say because he was in a bit of an accident about an hour and a half ago. He texted me with a kind of a nasty video of a couple of beat up vehicles and said, hey, here's the current situation. I'm still planning on being there, but if I'm not there, this is why. But he's here, and he said he'd still like to share briefly, so Ben, you can come on up. Thanks for being here. Very grateful that you're okay.
Yeah, as am I. Thanks for having me, Jake. Yeah, so no fancy slides tonight. Sorry about that. Not that I was going to anyway, but probably a little less prepared, but you can bear with me, I'm sure. Yeah, so who watches the news around here? I don't know, maybe nobody, but I'm pretty sure a few people do. So if you've seen the roller coaster in the stock market this week and plenty of talk flying around about entering a full-blown recession, it's kind of an interesting week, right? Which to me, seeing that, yeah, and then we bounce back. It's like, well, maybe all of that was just a blip on the radar, and maybe it was, maybe it wasn't. But it'll be. We've seen the market dealing with interest rate fatigue. Just people tired of it. It feels like the people that were going to buy regardless, generally more or less have bought, and there's been a bit of a slowdown locally. So there's an opportunity there for buyers for potentially the next few months. If you see stuff on the market, don't be afraid to make offers. We're in a different spot than we were 6 months ago, a year ago. So that's interesting to watch. But then, where does it go from here? Does the market really tank enough for interest rates to be impacted and come back? Maybe. But one thing I want to talk a little bit about is regardless of where that goes, what we do as investors doesn't really change that much. Markets will go up, markets will come down. I've seen Eli crush it in both, and it's awesome. So good work. But the way I would view it is our jobs as investors, we basically have two jobs. One is to build a quality portfolio, right? The other is to keep enough margin there that we can choose when we buy and sell. If you do that well, you're going to crush it over a long period of time. It is what it is. Like you look at everyone that does really, really well over the long haul. Your Warren Buffett's someone that you're always going to hear in those conversations. That's all they did. Build a quality portfolio, became world class at something, and it could be real estate, could be the stock market, could be something totally different. Just get really good at it. Keep enough margin there that you can choose when you buy and sell, and you're going to be awesome. So it doesn't change whether the economy's up or down or sideways. Just do your thing, do those things well. Wanted to say too, I'm stoked to hear from John tonight. When I saw he's speaking, I had to be here. John and his team have been fixing my books since 2021, which a lot of you probably don't know this about me, but I love building stuff. I love making the pieces fly. I do not love counting the beans, and John would attest to that. He cleaned up a royal mess, and my life is much, much better because of it. So get yourself a John if you're not great at that area. So thank you, Jake. I think that's all I got.
That's a good word. So keeping plenty of margin. I agree with the plenty of margin, Benyo. How much is plenty?
Okay, I'll speak to that for a minute. For me, it's always just been a backup plan. And so backup plan number one is a line of credit. Scott's going to laugh because he sees this intimately. Backup plan number one is a line of credit. Backup plan number two is a group of private investors that I've had great relationships with for 5 to 8 years. Always did what I said I was going to do with them, and they're always happy to write me another check for 200 grand or 500 grand or whatever it is. Like, seriously, that's my backup plan. So don't think you need a ton of cash in the bank. Relationships can do the exact same thing for you. Cash in the bank is great, though, so I'm not going to say you shouldn't do that.
That's good, or whatever it is for you, just some sort of margin. And it's tough, especially as a beginning investor. And honestly, if someone's just starting out, might as well go 80%, might as well max it out if it's your first deal. As you build a portfolio, in my opinion, you might want to scale that back a little bit and not be leveraged as hard. But everybody has their own opinions on what a comfortable number is, and that's fine. I'm a little bit annoyed that I forgot to print out my notes tonight, so that's why I'm kind of clumsily working with my laptop, because I do have a couple of things I want to share before we bring John up. One of them being a notice that I got from my bank a couple of weeks ago. How many people in the room have some nice 5-year notes that are about to expire or have just expired, and you now have a higher interest rate? I see a couple hands enthusiastically waving. For many of us, those are starting to come around, and it's interesting. I would very much go back to what Benyo just said. He didn't say it in these words, but I have said before, we can spend all kinds of time watching predictions, right? I would highly suggest we spend more time studying principles than predictions, and that's exactly what Benyo was talking about. Just doing the right thing, get in the game, keep a solid portfolio, whatever that looks like to you, and you'll be fine. But anyway, just for this particular property, it's a 5-unit that I own in Lancaster City. Luckily, the debt is down currently to $212,000. My interest rate went from 4.1 to 7.6. My payment went from $1,610 to $2,010, so it went up an even $400. My principal pay down went from $875 to $616. So if you're half decent quick with math there, I'm paying $400 a month more. I'm getting $250 less principal pay down. So it's basically costing me $650. My interest went from $734 to $1393. So that's all additional interest. I haven't heard that any of my tenants want to pay me $650 a month more. To be fair, some of that has happened over the last 5 years. So not complaining. I'm glad I owned real estate in the last 5 years, even if the interest rates are not what they were a couple years ago. But that was my first one that came due. There's going to be a few more trickling in, I think 1 or 2 more this year. And, if it's a 5-year note like most of us had, you don't have too many more years left on those. But who knows, it might come back down again. I'm genuinely curious what's going to happen in the next half a year, don't know. Totally random or totally off the wall topic here, but how many of you are familiar with the term or have heard the term sovereign citizen? Maybe like 25% of the people. This is fascinating to me, and it could be a little bit of an educational thing. So Judge Jeff Conrad spoke here, 3-4 months ago. He called me today, which was great to hear from him. And he said, hey, I don't know if you're aware of this or not. There was an Amish guy just yesterday had a run-in with Judge Brown in the courthouse, and he was claiming to be a sovereign citizen. Google's definition of a sovereign citizen, it says sovereign citizens believe that courts have no jurisdiction over people and that the use of certain procedures, such as writing specific phrases on bills they do not want to pay, and loopholes can make one immune to government laws and regulations. I did some research on it this afternoon. It's pretty fascinating, actually. People that claim that the laws of the land don't apply to them, things like property tax, income tax, vehicle registration, the court system, there's this logical reason to them that they say it doesn't apply to them. And in the words of Judge Jeff Conrad, he says it is total nonsense. And that is good to know, because if you don't pay your property taxes and you don't pay your income taxes and all of those things, you will very likely end up in front of a judge. And if the judge says it's total nonsense, it might be good to know that in advance. And if that's not enough, there's scams going on with people selling these documents and educating people on how to become a sovereign citizen so that the laws of the land don't apply to you. And it's bogus. And one of the reasons Jeff called is he said, if you guys ever want me to speak to your community on this, I'd be happy to do that. Which I'm like, let's get him to do it. I'd love to hear Jeff talk about pretty much whatever he wants to talk about, because he's fun to listen to. So, sovereign citizen, it was news to me. Now I know what it is, and that you probably don't want to depend on that to get out of taxes. So we're going to have to look at some other way, and that's why John's here. No, the goal is not to get out of taxes. The goal is to learn all that we can so that we don't have to pay more taxes than what we legally need to, so that we can buy more real estate, right? So, a couple of things here I just want to touch on before John comes up, and this should be pretty fun. It's going to be somewhat interactive. John has a few people that he's going to bring up, talk about some real-life stories. In my opinion, taxes and accounting is probably one of my most boring, most complicated topics, and but it's fun to learn, and then it becomes a little bit less complicated and a little bit less boring when you actually kind of learn some of the rules. One of the things that is super frustrating for most of us when we kind of go down this road, and it'll probably happen tonight. Sorry if I'm stealing your thunder, John, but somebody's going to ask a question, and John's going to be, it depends. And those answers don't bring us a whole lot of clarity, but it's the fact that a lot of the things that we're looking at, it depends so much on our personal situations. Even when you get to a place where you realize you can take a deduction, just because you can doesn't necessarily mean that you should. If you're selling a property, John might tell you that, yes, you could do a 1031 exchange, you could save $5,000 on taxes this year. Seems pretty simple, right? Well, just because you can doesn't always mean that you should, and that is why tax planning is important, because the deduction might be worth more to you down the road. I don't know. For a lot of people, just starting to learn some of the stuff that John's going to be talking about tonight, and they start to see that someone that makes a lot of money pays less taxes than someone that is maybe an average wage earner. And the first response to that might be, well, that's not fair. And that's probably a correct statement. And it is very important to know that the tax law was never designed to be fair. It was designed to encourage certain behaviors. The government gives us incentives to buy houses that people can live in. We are better at doing that than the government is. They have tried it, and they continue to try it. They're not very good at it, so they incentivize investors to buy properties. And that's just one example. There's many, many other things you can do. So they will incentivize you. They'll give you different loopholes, for lack of a better term, to not, to get out of paying as much taxes. So now, having understood that, it's also important to know, in my opinion, that just because the government is incentivizing you to do something doesn't necessarily mean that you should. One of the most basic things is, going to be a lot of debt, because I don't know of any ways that you can be tax efficient investing if you don't use debt. So the more debt you use, generally the easier it is to keep your taxes under control. That's each to his own, but you have to decide what's good there. Just because the government is encouraging it doesn't necessarily mean that it's great. Another example would be things like opportunity zones. I do not have experience with that, but I've heard of people investing in what the government calls opportunity zones. There's more tax advantages, and then they also have more control, and they're generally areas that they're trying to spur some growth, and they're generally rough areas. So again, just because the government is encouraging you to do that doesn't necessarily mean you should. You need to use your own discernment on that. So one more point, and then I'm going to bring John up, and that is just the fact that I feel like I still just know such a small part of the tax law, but I know a lot more than I did 15 years ago. And it's really liberating when you start to understand more and more of that. And we have various, some people in here probably know it quite thoroughly. Some people don't hardly know anything, and you're going to be totally left behind. Or it's going to feel like you're totally left behind with some of the discussions probably. But I would just encourage you to don't feel like you have to learn it all at one time. I've been doing this for 15 years, and I looking back, I realize what I learned mostly comes from just a little bit here and a little bit there. And some of these phrases, I'm a little bit of a slow learner on this stuff, honestly. Many of you guys will learn this stuff a lot faster than I did. It takes me a while to catch on to some of this stuff, all right? So you don't learn it all at one time. You learn it a little bit at a time. You pick up some concepts here and there, and 15 years later, you realize you know enough to get around. And then you find a guy like John that can really kind of tie it up for you. I've been working with John for probably 4 years, something like that. Never before did I have that good of a handle on my taxes. Never before did I pay an accountant that much money either. But I am happy to pay a professional to do what a professional does. John and I get on monthly calls. There's always something that we talk about, some loose ends to tie up. I have ongoing notes on my phone, things that I want to address the next month. Sometimes we get on a call and I'm like, we really don't have a whole lot this morning, John. This will be a pretty quick one, and we might be on the phone for 45 minutes because something else comes up, and it's just a way to be proactive. So very grateful for John. As Benyo expressed, it's just most of us don't enjoy doing this kind of stuff, but there's a few that do, and we're happy to pay them to study this stuff extensively and help the rest of us with it so that we can go out and do the stuff we actually enjoy doing. So with that, please help me welcome John Lapp. We're going to take a quick minute here and strap this thing on.
My beard doesn't get in the way, right?
And I'll let you clip that thing. Test that out.
Test. Is it turned on?
I don't think it's adjustable. I think when you start talking, or maybe it
is. Is it turned on? Can you guys hear me? Can you guys hear me in the back? Okay.
You speak up a little bit. You're good.
Yeah, Jake, you had me excited there a minute when you were talking about a sovereign citizen.
Oh yeah.
Yeah, I was about to sign up. I was like, where do I sign up here? Sounds too good to be true. So, yeah. My name's John Lapp. I'm with a company called Duco Accounting. Started the business here 4 years ago. Here's my family. My wife Liz is over here. Ben, our oldest, is here. And we have 4 boys. Ben had helped me out in accounting for 2 years, but now just recently in the last 3 months, he went and got another job. So we miss him, but we bless him with where he's going. So so I'm the owner of Duco Accounting. Got started in taxes in '08 by signing up. I was a business owner at the time. Signed up for a course at H&R Block. Just signed in the window, said you want to know more about taxes. There was a number. I think I took a picture or wrote the number down, and waited a couple months, and was like, okay. So after a while, I called the number, and it was an 8-week course. Realized sometime, I think it was the last class I was in, that if I pass over 80%, there's opportunity for employment. And so I passed over 80%. I went from not knowing anything about taxes to actually sitting there and doing a tax return. And I was like, I couldn't type at the time, so I was like pecking away and doing tax returns for people, 4 months later, after not knowing anything about taxes. And from there, it just interested me, and I started digging in more. I am an enrolled agent. An enrolled agent just basically means I can represent anyone or any business before the IRS. I can get if I get a power of attorney, I can speak on anyone's behalf. You know, it was a 3-part test that I had to pass, 100 questions per test. They basically locked me in the room, took everything from me, and said I need to pass the test. And I was able to pass it, so thankful for that. I enjoy, in my pastime, I enjoy biking. I ride about 2,000 miles a year, and there's my bike. Here's a group that I was out with one Saturday morning. This is up on top of Red Rock at Ricketts Glen. It's a 2-mile hill that's over 1,000 feet of elevation gain. And the bottom of that hill, I know it's going to take me about 30 minutes to climb that thing. 2 miles in 30 minutes. And it takes you all the way down to under 2 miles an hour at times. And I look at riding a bike, and it's actually interesting because the same day I rode my bike the first time was in, I think it was July 5th, 2017. And I rode it, put a backpack on my back, and it's when I enrolled in Liberty University in college. And there's a lot of similarities between the two, because there's sometimes, as you're training and stuff, you feel like giving up. And it's the same thing with college. There was times I wanted to give up. There was times I wanted to just be like, okay, this is not worth it, you know, all the studying and stuff. But, you know, you stick with it. And it's same with the 2-mile hill. I knew it at right around 30 minutes, I'm going to get to the top. I knew it's like, I just had to. So I was like looking at the clock. There was like, this thing was going. I mean, it was steep. And I was like, okay, I'm 25 minutes in. 5 more minutes, I'll be at the top. So this is just, yeah, it was some of the crazy stuff I do, but I enjoy it. Information tonight is for information purposes only. This does not constitute any tax, legal, or professional advice. Talk with your tax accountant for any tax advice. Tonight we're going to talk about some basic tax principles, which are going to include strategies to reduce taxes, ways to stay compliant, how to handle an IRS audit. And I promise I'm going to try not to bore you guys with this stuff. We're going to have some interaction. I have a couple people that are going to come up. We're going to have some real-life stories just so that we can maybe connect with stories rather than just me here giving you some information. We're going to talk about best business practices, the importance of relationships in business, some new and innovative tools. We're not going to cover much, Cheryl, with that. Then there's going to be some additional call-outs, which is information about the FinCEN. You guys all have that on as a handout. It's been a big thorn in our side, but we're not sure what to do but to comply because we're not sovereign citizens. So, or I guess we're not. It's And then we're going to talk a little bit about the Faith Builders SPE program, and then also just a little bit about scams and stuff that get sent out and how to avoid those, how to avoid falling for some of those. I do want to shout out to Kaylee. She's one of our employees. She's the one that got the slides together here, because without her help, this would probably be a disaster, or if I would have gotten it together. And also want to recognize Scott tonight. Scott is one of the employees, and he helps out a lot with the bookkeeping stuff. So with that, we're going to talk about depreciation. I think depreciation can be very misunderstood. And what is depreciation? When does it occur? How does how does it work? Because in some ways, depreciation is sort of like magic, because you buy an asset, and then you can take that full amount of that asset and expense it in the same year you bought it. Depreciation originally was a way of buying an asset. If you bought this asset, you figured it would last for 10 years, you would take a portion and expense it every year for those 10 years. So that was the initial thought behind depreciation. But then it became a tax incentive. It came, businesses could improve their business skills, they could improve their equipment and stuff, and the government would give them a write-off to do that. And then with that, they could grow their business faster, and they could support the community, they could support other people. If you look at taxes as an incentive, the government, it's a government's way of trying to tell you where to spend your money, where to invest money. It's a little bit different way to look at taxes, but that's sort of why the tax code was written. In some ways, it's a series of incentives so that you do what the government wants you to do. And then if you don't, you basically, in America, we don't have an income tax. We have a consumption and a savings tax. So you get taxed on money that you consume or money that you save. If it's income and you invest it in the correct ways, you don't have to pay taxes on it. And there again, that's emphasis on the investing in the correct ways, because that can make all the difference. With depreciation, what is depreciation? We covered that a little bit. Depreciation is buying an asset, and normally it would have been looking at the life of that asset and expensing it over the useful life of the asset. When can depreciation be taken? The key word for depreciation, or for taking the depreciation, is placed in service. When was this item placed in service? And that's, if someone says, hey, they have a rental property, my question would be, do you have tenants in it, or are you fixing it up? If you don't have tenants in it, it's not placed in service. And so you can't start taking depreciation until the property or the asset is placed in service. Same with an Airbnb, short-term rental. Short-term rental is becoming all the rage the last couple of years. Short-term rental losses, that are losses because of depreciation can offset active income. And so then the question is, how do you prove that it's a short-term rental? Because the IRS code says anything that's rented for 7 days or less. So if your short-term rental is ready for rent on December 31st, can you prove that it's a short-term rental? Because you have no rentals yet. So you don't know if it's 7 days or less. So for short-term rentals, we recommend having at least 2 rentals before the end of the year, so that you can say it was placed in service and we're under this 7 days average per year. And then you can take those deductions, and we found that to stand up in court. So depreciation can be used even if the asset is fully financed. You can buy a $100,000 tractor on December 25th and place it in service and fully finance, not a dollar out of your pocket, and you can depreciate that whole tractor, reduce your taxable income by $100,000 that year if you're a farmer. Depends what you're doing, or depends what you're going to use the tractor for, but just as an example. Yeah, so again, how does depreciation work? It's basically taking It's different for for assets like tractors, for an equipment. You can take the full amount of that, whatever the purchase price is, and depreciate it. For assets like houses, you have to split out land. Land is not depreciable, but the building is. And so you have to split out land and building, figure out what percentage is building, what percentage is land. And then the percentage of the building can then still be broken down even further into 5-year property, 15-year property, and 27.5-year property. But that would be done through a cost segregation. The problem then becomes if you do take depreciation, there's always so the IRS allows you to take this depreciation, but if you were to sell the asset, you might have to recapture that depreciation in the following year. So back to my example of a tractor, $100,000 tractor, you buy it on December 25th, you sell this one on February 15th, and you sell it for $100,000. Now you have $100,000 of active income that year, just off of selling that tractor because you had depreciated it in the year before. So that's what depreciation recapture is. So and depreciation recapture is taxed as ordinary income. So if you're looking at a property, you purchased a property 10 years ago, purchased for $130,000, you depreciated it $30,000, so now your basis is $100,000. And you sell it for $200,000, $30,000 of that might be depreciation recapture, taxed as ordinary income, and the other $70,000 would then be capital gains tax. So it's broken out into different portions there. I'm going to get Jake to come up. He's did such an amazing job earlier. So just explain. Yeah, come on up, Jake. He did such an amazing job earlier explaining taxes and everything. So I figured maybe he can give us a little more insights here. Jake, if you want to, you can just take a seat there and talk a little bit about cost segregations and some of the experiences that you had over the past 5 years.
Sure. Can I make it pretty quick?
Yes.
Because I know you got a couple other guys you want to get up here, and I took more time at the beginning than what I was going to, so we're going to keep it rolling. So what I had mentioned to John that I would be willing to share on very briefly that I think could be helpful for some of us is an online cost segregation study tool that I have used quite a bit. I remember going to meetings 10 years ago maybe. I would start hearing things like cost segregation studies. You can accelerate your depreciation. It was a way to front load depreciation to lower your taxes owed. And then the question usually came up, well, how big of a, I have a 2-unit or a 3-unit, like, is it worth it? And they're like, probably not. At that point, the common thing was if it's not maybe a $600,000, $800,000, $1 million property, it's probably not worth it. But with an online cost segregation study tool known as KBKG. It's 4 initials, KBKG. You can do it online. I think it's $450 per property. John, am I correct that your accountant has to kind of sign off on that?
Accountant does not have to sign off.
Okay.
No,
So
you just put in basic information. I just got done doing it with 4 properties just a week or 2 ago.
Okay.
And no, you just put in basic information. One of the things that's important if you're going to do it is if you have any parking spots or driveway, and it asks how many parking spots there are. If it's a whole lane, you can actually get your square footage and then divide that by what a normal parking spot would be. So even if there's only 2 cars parking there, you might have 6 or 8 parking spots, because that would then become 15-year property, and it would reclassify some of your land expenses.
That's interesting.
Yeah.
So yeah, it's a pretty simple, I would say I probably spent 15 minutes maybe doing one. It'll ask you things like roof type, flooring, just a bunch of structural stuff that, you don't have to walk through the property to do it. If you're pretty familiar with the property, you can easily do it from your computer or wherever you are. And I think on average, you probably get somewhere around 25% of your total building value the first year, which is pretty significant because on a so you're probably not going to maximize it quite as much as if you would pay somebody to walk through and spend maybe more like 2,000 or more on the study. But it's a very simple, easy tool that I have used that has helped a lot. And I would say, properties down to, I mean, it depends on your tax situation, I guess, but $100,000, $150,000 property, if there is any such thing anymore, could still be worth it if it works well for your tax planning. So,
two things with that. So we just got done doing that just last week, and we were able to accelerate. I think it was 87,000 of depreciation from 4 properties. And then the other thing is, I just heard on a podcast that the KBKG study came up in an IRS audit, and it held up in court. So the courts did recognize that as a legitimate study, and they accepted the results of that study. So
that's good. And apparently this just changed. I was just looking it up, but you can do it on properties, or you can do it on a depreciable asset up to 1.2 million. So if your property is worth 1.4, 1.5, depending, most times you're 80% or 90% for the building. So I think that's new, because I thought it was more like 600,000.
I was thinking it's limited to 600,000.
Yeah, so
That's
I think
what I was thinking.
If I'm not mistaken, that just changed to 1.2. And I think it's limited to maybe 5 units or 6. There are some limitations, but when you get bigger than that, you're probably anyway better off paying somebody a little more to do a.
I would say in the $350,000 to $400,000 range. If you're over that, you might be better just going with a professional cost segregation, because what I found with the KBKG is normally they're around 20%. They're a little lighter, whereas your professional ones can be 25 to 28%. For those cost segregations. So yeah, thank you, Jake.
You bet.
Thank you, Jake. Yes, the last one here, just with depreciation recapture. Make sure it's always tough when someone asks, should we take this depreciation, because we have to make sure that that our clients are educated that if they ever do sell an asset, that they want to make sure they're not just selling an asset, but that they are planning, because the tax planning portion is really important. You always have to plan your next steps before you sell, before you do something else. You have to make sure you know what you're doing. What are you doing with the money? How are you not going to, how are you going to keep reaping the benefits? I mean, you can do 1031 exchange. You can buy. Right now we're at a 60% bonus depreciation, so you can potentially buy something, depreciate that, the next property. But it's always once you start using depreciation, it really becomes a game, and it becomes a game of knowing, I sell this, I need to buy something else, or I'm going to pay taxes. So you're basically kicking the can down the road, but you can kick for a long time if you keep planning. There's a lot of kicking. Another strategy to reduce taxes is the Augusta rule. The Augusta rule, you can rent out your personal residence up to 14 days per year. And the business can deduct, if you rent your personal residence to your business, the business can use it as a business expense. You don't have to recognize it as income on your personal return. The income received from the rental is tax-free to the homeowner. This can also be used, like if you're living close to State College, you have a Penn State game. You can open your house, but you can do it for 14 times in a year. If you do it more than 14 times, then it has to be recorded as income on the tax return. Solar installations for business. You have the depreciation benefit. You have the tax credit, which is 30% right now if it's done under the there's extra there's extra things you need to either pay prevailing wage or be under the 1 megawatt the 1 megawatt, right? Yeah, go ahead.
Businesses wouldn't be in that prevailing wage thing, but that's like large projects that you, but typically 30%.
Yeah. And then, are there grants? Maybe there's grants out there somewhere. Because PA has some pretty good grants that if you're out in, out in rural areas, you can get some grants. You are out in rural areas. Yeah. Did you check where we're at or what? Yeah, okay. Yeah. Another strategy that you can use is you can hire your children. Hire your children for work that they might already be doing. Maximum annual pay that can be taxed at 0% is the standard deduction. So you can pay your children maximum up to $14,600, and you can even pay more than that, but anything more than that, they might have to pay a little bit of taxes. Here's the problem. Child's parent or parents need to be 100% owner of the business. So this cannot be done through a partnership unless the partner is the husband and spouse. It's not available for S corporations. So and the other thing is the child has to be put on payroll. I did not add that on here, but the child would have to be put on payroll. So, but that is a way that you could take advantage of that. Step-up basis. I think this is something that maybe people need to be educated on. Step-up basis is when a person passes away, their assets basis reset to fair value. So if Grandpa has a farm, he's still the owner. It's worth $2 million. He paid $100,000. The day he passes away, well, if it's if it's owned by both him and his spouse, it might be different. But if Grandpa passes away, he still owns the farm. It would reset half of that value. If he would have paid $100,000, it'd be worth $2 million. It would reset to $1,050,000, and then the basis would become $1,050,000, and you wouldn't have to pay capital gains from the $1,050,000 out. So it's actually, and this can be done. This can be done, even if someone passed away 10 years ago. The asset didn't get sold. No step up was done. Now the asset gets sold. You can still go back and see what the fair value was when that person passed away, as long as he owned that asset. Reduction in capital gains tax. No depreciation recapture on step up in basis. Additional considerations is what I just said is for non-community property estates, if the property is held jointly and one of the spouses passes away, that spouse's basis will step up. So it would be a half of the basis will step up. But that can be pretty powerful for people that hang on to real estate, or if there's appreciation in real estate, and even maybe a conversation if Grandpa is getting really old or something, maybe he wants to just hang on to the real estate, maybe put it in his will, who gets the property afterward, because it could save a lot on capital gains at the moment. So. Personal home exclusion. This is where you buy up to $250,000 of gain. $500,000 for married couples is excluded if you sell your personal home. Personal home stipulation is you must live in and own the property for 2 out of the last 5 years. So if you're looking at selling your property, just make sure if you're getting close to that 2-year mark, keep it for another month or two. You might might save you $250,000, $500,000, who knows? So just something to keep in mind. Oil and gas investments. We had a couple of people that invested in oil and gas. They have not gotten money back yet. They invested a year ago, and they saved about 20% on taxes. I talked with them today just to get some feedback. They have nothing negative to say. They're still waiting to see. They haven't gotten any income, but they weren't promised any income until later this year. So they're just looking at how the well is going to perform, how the price is going to do. But strictly from a tax perspective, it's a really good investment. I mean, if you're looking strictly from tax, from a tax point of view, can often offset active income, particularly through the use of intangible dwelling costs and depreciation. There is one thing most of the oil and gas investment opportunities require contributors to be accredited investors. And accredited investors basically just means they're more sophisticated investors, and they have either $1 million of net worth or $250,000 or more of annual income. There's a couple others, but those are probably the two thresholds that are the easiest to reach. So I'm going to get Alvin to come up. Alvin's going to share some real life stories, and go ahead, Alvin. You can introduce yourself.
Check, check. My name's Alvin Lapp. I'm John's brother. I taught him a lot about taxes. Yeah.
True.
I own a few businesses, own some real estate with John. Yeah.
Yeah. So actually, I started doing Alvin's taxes probably back in, I think he was one of the first ones I did. So
Even at H&R Block, he
yeah.
was my accountant.
Yeah. So Alvin was sort of a, would you say, guinea pig, or, you know, so we could have more conversations, and if I messed up, maybe it wasn't as bad, or, you know, I don't know. But yeah, he's been a trusted brother, and we're just going to go through some of the strategies that he used over the last number of years. And so in the past, he's purchased a business in 2015. And then in 2018, they purchased another business. And with that business that they purchased in 2018, they actively participated the first 2 years. And so right when he bought it, he could depreciate the assets. He could offset the depreciation from this business. They could show a loss in this business and offset the income in this business right here, because both of them were active. He was participating actively in both businesses. A couple of years later, this business here started doing pretty well. And so we started looking at his tax situation. We're like, hey, how much time are you spending in this business? Can we switch this over to passive so that this now becomes passive income, and you can start offsetting passive expenses or passive investments with this business investment. And then he remodeled his basement, put an Airbnb in his basement, which offset active income from this business right here. And
the renovation of the basement came as a pain point, because I invested like 60 grand on the outdoor space, and I was complaining to John one day. I'm like, how I need a write-off. Like I can't just sink 60 grand into this space and not have a write-off. Like, it's just ridiculous. And he's like, well, why don't you put an Airbnb in your basement? And I'm like, well, the basement desperately needed a remodel anyway. I'm like, well, that just makes sense.
Yeah. So the outdoor space then became a write-off because the clients or the tenants or the guests use that space. So now it becomes a rental portion of his property. And then Al and I were able to invest in rental properties to offset his passive income. That's happening up here, which is pretty cool. Made improvements to rental properties that also offset passive income. And last year, Alvin, a couple other brothers, built a short-term rental, actively participated, and offset active business income. Oh. Yes and no. Yeah, no. Yeah, yes and no. It's more than one. It's more than one. So yes and no. So, yeah. I did. Yeah, I'm not sure when that one came in, but yeah. Thanks, Joe. Thanks for pointing that out. Here's in action. So now the present. So this year, we have they're building a shop on the property where the active business is. So that can be active losses. The shop, maybe not as much, but the infrastructure, putting the lane in and stuff like that, that can all be 15-year property. they're doing, yeah, land development. The land development can all be 15-year property. And then purchase a couple of rentals and made improvements to others, so that can offset the passive income. So now, future opportunities. The question is, if Alvin were now to go sell everything today, what would his taxes be? You know, because he has a lot of depreciated assets. You know, is it wrong? Not necessarily. He just needs to know that anything he sells or anything he does has a tax implication now. And so it's like it becomes a game that you start learning to play. So
he could just die.
yeah. I didn't say that, Joe. But yeah, so cabin, you know, he has a depreciated cabin. He has a depreciated personal home. And so even with the home exclusion will not take care of the depreciation recapture. So the depreciation recapture would have to get satisfied first, and then because that's a business portion of his home, and then he could only take the business use, the personal residence credit after that. He has business assets, a lot of business assets that are probably mostly fully depreciated. And you know, he has a shop building, land development. It's not necessarily wrong. It's just, you know, as he does his next investments, like, hey, what can I do? What do I need to do this year? You know, how do we do that? With these strategies, you know, we are well north of 100,000 in tax savings over the last couple years, and you know, it's like feels pretty good. But it also it feels risky to do this with someone that doesn't know. It's just like, hey, John, take care of my tax problem. Hey, I got a tax problem, take care of it. It's like, well, you know that I can take care of it this year, but it might be a worse problem next year. And I don't want you to go and be like, oh, this guy messed up my taxes because he depreciated everything in 1 year. You know, so it's also an educational thing. It's not just but like, hey, take care of it, because we can take care of it. You know, I could get I was going to say I could get all of your taxes down to zero, but the W-2 ones might be hard. But any business tax is easy. Just write me out a check, right? If it becomes a business expense, you can write it off. Right? But here's some of the reasons the government gives incentives for, and some of the reasons we get depreciation, because Alvin now has depreciated assets, but he also fixed some stuff up. Here's a property that we purchased, and here's a before and after picture of that. Here's how the kitchen looked, and that's how the kitchen looked after we had it fixed up. This is a 1-bedroom, and yeah, new carpet and little new paint. Then the bathroom, you know, there's a before and after of that one. So this was his house, and this is the backyard space that he wanted to fix up, and then we had to do an Airbnb to get the tax deduction.
But it is kind of cool because the one cool thing about this property, Benio helped me buy it in 2017, and in 2021 I refied for 2.375% interest, locked in for 15 years. So I'm living there rent free right now. The Airbnb is paying all my payments. So.
Yeah. Yep. Okay, thank you, Alvin. Give it up for Alvin. He didn't get audited, but we're not afraid of that. We think we have everything. We have everything in order, and we'll be able to defend that. So, yeah. Ways of staying compliant. Documentation. Here we go. Here we go, Yeah, here we go, Mel. Documentation, accurate record keeping. We like to retain digital copies because the other copies can get lost. Another thing, with the digital copies, there's actually a lot of searching that we can do. I could find, like, if there's receipts and there's a dollar amount, I can search for the dollar amount, brings it right up to the top. And I'll be talking about that a little more later on an actual audit that we worked on. But I was able to go in with, I think there was like 450 documents, and in a matter of 30 seconds, I could pull a document for an expense and match it. And so that was pretty cool with it, having that digital. There's no such thing as too many documents. I mean, I know it's a pain for you guys, and it's a pain point for most business owners, but when it comes to an audit or when it comes to defending something, some documentation is amazing. It's just because, like, we want to, if it's an audit or something, we want to win. We want to go in there, we want confidence, and we want to know that we can substantiate everything that happened. Be timely, file records quickly, make and record payments as they're made, correct classifications. We've seen like line of credit transfers be classified as income. If someone does a $50,000 line of credit transfer, you classify it as income. Guess what? You're paying taxes on that $50,000 that you just transferred. It's not taxable income. It is just a transfer from a line of credit to your checking account. So just make sure that you're keeping those things straight. Determine any expenses if they're ordinary, necessary business expenses. You have documentation. You take them. You don't have to worry about. You don't have to worry about the audit or anything. Stay informed. Understand how to apply the correct tax rules. And then learn your business. Learn to know about the unique expenses, how to use them to your advantage. Stay informed on what you have. Expenses may need to be substantiated. And that's right there. For the IRS, you are guilty unless you prove that you're innocent. It's not innocent until proven guilty. It's guilty until proven innocent. And the reason is you're saying we can take these deductions, and then they're saying, okay, prove it that you can. And it's sometimes it doesn't seem fair, but that's what we have to deal with. So I'm going to get Matt Glick to come up. Matt, you can just share your name, your business, and anything else. If you go too long, I'll be like, hey Matt, we got. if you go like 15 minutes, I might take to
Yeah, my name is Matt Glick, and in February of 2023, my wife and I started a business, and I knew from the beginning that I wanted to jump on John's wagon, start kicking the can down the road.
Yeah, thank you, Matt. So Matt started a business he came to us, I think it was a couple months before he started a business. He was like, hey, thinking about starting a business. I'm like, okay, great. What are you going to do? And so started a business in 2023, and it was interesting because it was basically a handshake, right, Matt? That's how you bought the business. You were like, hey, we're going to pay this amount. Yep, thank you. And there was no documentation. There was no purchase agreement, no sales agreement. And so I was like, Matt, we need to come up with values of the assets that you purchased, because the assets can be depreciated. If we don't come up with values, how are we going to know what is depreciable and what is what's goodwill? Because goodwill gets amortized over a longer period. So we split out the assets, and then we were able to, in the first year, take the depreciation we needed because we had split it out, and then the actual assets we were able to depreciate. Now Matt has to worry about what's depreciated, what's he going to do if he sells something, but it's not a big deal. You just keep track of what you have, and one of the things to keep in mind is, like Matt, you bought a cooler, right? You had a cooler that was already installed.
Right. There was the equipment that came with the business needed fixed up or all new. So we put in some new equipment this year and last year, right when we started, we put in some new equipment and just continue to chip away at upgrading equipment.
Yeah.
We have a produce stand down in South Jersey.
And so the cooler that he purchased, he put a value on it. We depreciated the first year, so now the IRS looks at it as a $0 value. It's probably there. It might be worth $20,000, but in the eyes of the IRS, it's worth $0. So now Matt can go in, upgrade that cooler, put in a $40,000 cooler, but then he only gets the difference. He only gets a $20,000 write-off rather than a full $40,000. So that's how that depreciation recapture. But if he buys a cooler the same year that he sells this one, he'll be fine. So, then future opportunities, possibly short-term rentals, Matt, right? Maybe short-term. We're trying to figure out he's actively involved in his business. So what can we do to offset some of his income, with where he's at? Short-term rental is an option. Purchase a property maybe, but if he does a long-term rental, we would have to look at is it going to be beneficial for him, or will there be tied up passive losses if he buys that? And then as long as he knows that it'll be fine. But yeah, that's what we're looking at. Thank you, Matt. Yeah, give him a hand. So those are just a couple options there, a couple things, and then in business, I can't express the importance of relationship enough. I can't stress it enough, because you're dealing with other people, you're having these transactions. Very important to be able to communicate, expectations. Whatever, if you're in business, you're serving the other person, and the more you get to do that, the better you'll be. Respond to emails and voicemails promptly. And I'm not saying within 5 or 10 minutes, but within 12 hours, within 24 hours. Just make sure you're getting back to the person. Provide information speedily. Keep a good conversation flow with professionals that help you. Give yourself some cash cushion. Cash is king. The importance of liquidity, and avoid overextending your resources. Just some good business principles keep in mind. Things to remember to handle an IRS audit with confidence. This is communication. IRS will never make initial contact through phone or email. First contact will always be in a letter. So if you get a call from the IRS, say, hey, you owe $50,000, we're going to put you in jail if you don't do this, just hang up. It's not a big deal. But if they do send a letter, you don't want to avoid the letter. Because the letter has way more, it's way more scary than a phone call. Phone call and email, don't waste your time. Delete the email, hang up the phone. It's that simple. Remain calm. Before you do anything, ensure that just make sure that it's actually real, because there's so many people out there trying to get your money. There's actually Scott and I were in a meeting with where they were talking about data security and just the scammers. There's people, they're running it as a business, and they get paid certain amount per phone contact, certain amount per social security number. So you could be working all day and be like, okay, I got 10 social security numbers today. Well, they're worth maybe $1.50 a piece. So, and these, some of these people are living overseas. They're tapping into your database trying to find who you are, and it's like, it's happening more and more. and it's a real business for these people. They're doing it as a business, and so it's crazy. And then they're selling stuff on the dark web. They would say, I have the admin password into the Microsoft admin password for this business that's doing $5 million. Starting bid is $250 or something like that. And they sell it, and then it's like Amazon or it's like eBay. And it's, the starting bid's $250. The sale ends on, what is it, maybe 5 days from now. Highest bidder gets it. They'll give them that information, and they don't even want your information. They just want to sell it to the next person. That next person, they might be good at hacking a Microsoft account. They'll be in and be like, hey, can you give me the money? I'm in your account, whatever. But yeah. IRS audits. Never do it alone. Don't go into an audit solo. Seek help from a professional. It's interesting with an IRS audit. I've handled a couple of calls, and every time you call the IRS agents, they'll be like, hello, my name's Mr. Lapp. My IRS ID number is 100-057-7252. And I was told by a former IRS agent, he said, always stop him and said, can you please repeat your badge number, and can you spell your last name? So it seemed really awkward to do it first, but it's just, it totally flips it, because we have a number. We can report any of these agents that aren't professional. We're professionals, and we demand professionalism from them. So that's how we handle. Only give what is asked. Never give. Always err on the side of not giving enough of information, and have them ask for more information. Because if you give them too much information, after a while they'll have more than what they know how to deal with. Audits take time. This process can take over a year at times. Don't panic. I usually look at it as we're here to try to figure out what happened. It's not like this crazy, I mean, as long as you're compliant and you're not like these sovereign citizens. I'm gonna keep going back to that, Jake. There's sovereign citizens, because you know what happens, like 7 or 8 years down the road, these sovereign citizens have all their rental property taxes due, they have all their income taxes due, and all of a sudden it's like, you owe this amount of money, what are you going to do with it now? And they can either claim sovereignty and sit in jail with their sovereignty, or if they get caught anyway. But there's a good chance that they'll get caught at some point. So higher income equals more frequent audits. We have been hearing that with the IRS agents that are out there, that if you have over $1 million of aggregate income, you will be going into your income will be going into a separate tray. And those are the ones that they're going to start pulling out from audits. So one of the ways and that's aggregate income. It doesn't matter if you have a $50,000 loss. If you have $1 million of total income in your business, you can have a $50,000 loss. They can pull you for an audit because you had the $1 million of total income. One of the things you might want to consider is setting up an LLC, maybe going into a partnership with your spouse as a small percentage partner or something. That way the income comes over on a K1, and it's just the gross income, and it's not all it's just the net income. It's not all the income. So just something to keep in mind as we move forward with more IRS agents out there. Sam Glick. Sam's going to share a little bit about an IRS audit and all the fun that we're having. So go ahead, Sam.
Well, my name's Sam Glick. I'm owner of Glick Exteriors, and yeah, I was fortunate enough to start getting these letters from the IRS, I must say approximately back in 2021. I don't know if you guys ever do this, but you see an IRS letter and you think, what do they want with me? And you throw it in the trash. Well, that didn't work for so long. Long story short, after a few of those letters, they basically threw the books at me. At first it was, hey, we want to audit you. Then it came to, you $45,000 in taxes. Well, that got my attention a little bit, so I handed it over to another firm, not to John at first, and they said, just go through everything. And I try to keep track of everything, throw it in a box, that way if you need it, it's easy. I mean, it took me quite a few hours to go through every credit card statement, literally every receipt, mark everything up. I sent it over to this other firm, and things just weren't progressing very well. The IRS was being pretty short with me. I just tend to think that people, on the most part, try to be nice to people. So in 2023, I started getting whiff of some, so they were going to take me to arbitration at that point, where I'm going into the courthouse in Philly, not about a sovereign citizen, but about an IRS.
You like that too, right?
Yeah, so at that point I called John, and I said, hey John, here's what I got going on, and I don't know what to do. I had actually called them a couple of times. They were pretty short with me. So I called John. I said, hey, I think I'm going to need some help here. So he dug into it. Mine's been going on for over 2 years at this point, because the first year was with the other firm, and a little bit over a year ago I signed on with John. So
yeah, so I got involved in May of 2023. There was a tax court date set, and Sam sent me the information. I looked at it, and it was an amazing amount of documentation. It was like every bill was there that I needed. And I'm like, I looked at it, and that was my deciding factor, was because he had the documentation. I looked at the documents, I said, we're going to win this thing. We're going to go in, and we're going to, we're going to learn through it, and we're going to win it. And so I got the power of attorney from Sam. He signed his life away, right? Not
pretty
quite.
much.
Not quite. But it allowed me to talk to the IRS agent. This was actually in appeals, so this went to the Independent Office of Appeals. I talked with the agent and immediately started grouping the expenses. So what happened is Sam had 10 rental properties, something like that. They accepted all the income, and they threw out all the expenses. And they said, we need proof of all these expenses, even mortgage interest, taxes, improvements. It was everything. They just basically said, we need proof of all these expenses. And so we started sending information. I sent 295 pages in the last 15 months. I sent 295 pages through fax. There's no email communication. It's all fax communications. I had called the appeals officer 40 times and either left a message or had a conversation with her. And it's finally about last week, she told me, now we don't have the paper, we don't have the proof yet, but she told me I'm going to allow everything. I'm going to allow every expense that's out there. That we proved that they're all expenses. Said I'm going to allow everything. So she said she should have everything wrapped up in 2 weeks. So it's still a continuing story. So we'll see where it goes.
2 years and still continuing, and that's the one thing that was different with John compared to the other person. Like, I sent it over to the other firm, as I'm going through it, kind of lumped it together, and they basically send that over to the agent, where they look at it and it's not organized because I'm sending it over, and then they're sending it over right the way I'm sending it over. So they look at it and they say, well, they can't make heads or tails of this, and they don't have the time, because they don't, like the IRS agent, they're a government employee. What are they making? Do they really want to take the time? Well, John went through and literally made it easy for them to understand, and that's when the whole response started changing from the IRS agent.
And what was interesting is there was 33,000 of expenses that we couldn't find, that I couldn't find, and then I realized that it's on the K1 passing through to his personal return. And so I told the agent, I said, there's 33,000 of charitable contributions on this line on the K1. And I think I told her like 4 times, I highlighted it, And then she's like, oh yeah, on the K1, if I need to help, if I need your help to find that, is it okay if I reach out and give you a call? I'm like, yeah, that's fine. But that's what we had to deal with. You know, it's not like they had all the answers and they were looking to try to, you know, like disqualify anything. It was just we just had to prove that these were expenses. So thank you, Sam.
I mean, they're just doing their job at the end of the day, and they want to make sure that we're paying our fair share of taxes. I think Jake was talking about this. You know, as a business owner, we do get a lot of write-offs, and they want to make sure that we're just abiding by the law. And it's been, since I got John on it, it's actually been good. So.
It was weird because I would usually call and she'd be like, oh yeah, I think I have all the information I need for now. And then I'd be like, Sam, you know, there's an update. And like 6 weeks later, Sam, here's another update. And it's just like, it was like, is she ever going to get it? And then, I don't know if you guys remember when there was an earthquake, but she was literally working on his files the day there was an earthquake. And she was in Philly, and she got so shook up that she had to go home. And she only goes to, I think she only goes to the office like every 2 weeks or something. And so then we had to wait 2 more weeks to get more, for her to work on it again. She's like, oh yeah, it was so scary, I had to go home. Okay. But yeah, so for us, you know, we take the approach as a trusted advisor. We will earn the respect of the IRS agent. We will create a story by explaining, you know, your unique business and, you know, your operations and everything. I had one just a couple weeks ago, different person, and he was like, yeah, I'm not that familiar with this industry. Does this guy really need this many trucks? And I'm like, he might not need quite as many trucks. He should be able to sell 1 or 2. He's like, yeah, if he could sell 1, I think we'd be good, or you know, something like that. So, and it was more of a casual conversation. It was like, you know, he's just asking, you know, does he really need this many trucks? And when I told him that he might, he's like, oh, okay, that's fine. So, be an advocate in a legal and ethical way. I will not go to prison for anyone. Sorry, I won't go to that extent. But you know, there are times that we give them the information they ask, and we know that if we would give them more information, it would hurt our case. So we don't give them more information purposely. So tools and tricks. What do we got? I think I'm going to go pretty fast through some of these now. Discipline in business. Sometimes you have to say no. You have to say no to what you want now so that you can later have what you want most. This is sort of, yeah, these are just sort of jumbled together. So this is passwords. Everybody should have some kind of password protection. We see multiple passwords being used over and over again, and we also see, you know, like people writing it on paper. I think everybody should somehow get educated on a password, like Keeper, 1Password, something to keep your passwords, and then have them across all of your devices. That way, if you log into your phone, your password changes there, it changes on your computer as well. So there's services out there, but I would highly recommend it for any business owner. Promptly pay your bills. If you pay your bills as they come in, you know, the other businesses would definitely want to work with you more than if you're always going 45 days or if you're always going 60 days. You know, ChatGPT. That, Sam, you wouldn't know how many letters I got together with ChatGPT. I'd be like, yep, this is a good idea. I think Sam should have this deduction. This thing was done to make this property nicer. Hit enter, and this thing gets like spit out a nice report for me. So, FinCEN, this is a thorn in our side. This is every business, every LLC has to be registered by the end of this year. It's not a big deal if you get it done, but there's saying huge penalties if you don't get it done. Our suggestion is that get it done just so that we don't have to then communicate with them in January and February and try to figure out how to file it at that point. There's information in the handouts that we'd given you on that. It's a pretty simple process if you just go onto the FinCEN.gov BOI report there. And then anytime there's business, anytime the business changes addresses, or any of the owners change addresses, or if there's an ownership change, it needs to be updated. All businesses that are required to file, it's like a $10,000 penalty and maybe imprisonment. And then I want to touch a little bit on the Faith Builders, the SPE program, where you can send money to Faith Builders. You can have your PA taxes offset up to 90% through contributions made to local Christian schools or local schools. I know there was someone here, was it Justin? Justin was here at Shared like last fall, I think, on this. Now's a good time to get on with on this. You know, they're sending out their information right now. They have plenty of funds, or they should have plenty of funds. And you know, I would recommend getting signed up before, you know, October, November. That way they know how to figure out how much funds they have and stuff. This is a form that 2 of our clients got at the end of last week. Form 4965 basically just asks for basic business information. But if you read down over the form, the questions, so it says that your reporting entity is not the correct entity. And this is just an example of letters that some people get. But then some of the questions are just like, does the business process sales online? What does the IRS care if your business processes sales online? I think it's just basically a phishing. They charge $107. They charged you for you to give them your information, basically. It's genius. I mean, think about it. And yeah, questions? Any questions? That form does not exist. If you Google it, it does not exist. But looks official. It's a filing fee of $107. Says it's due by 8/1. It has all the information, but it's not. Yeah, looks so real, but don't send that. Don't send the $107 and all of your company information, so that then they can send you more information out. So, yeah, questions.
What do you use for electronic receipt storage that you can search?
So what we use is HubDoc, and that's like with Sam. I imported all of his receipts into HubDoc, and even his property management statements that had $38.41 halfway down the statement, I could search that in HubDoc, and it brought it right up to the top, and I could highlight, be like, this was from the property management, an expense, you know, from the property management. So it was. I was amazed. It was, yeah. He had so many documents. I just put them all in HubDoc as a single. He had them as a PDF with maybe 30 or 40 pages. I broke them all apart into every single page, broke it all apart, and then I could search them through that. But yeah, I was very surprised. Yes.
How do you bill for handling an IRS audit? Is it per hour or is it per headache per minute?
I actually, for this one, I almost paid Sam to do it because I wanted the experience. But no, I did an upfront. I said, this is how much it's going to cost you. I did tell him, you know, once we get this settled, depends what the outcome is, he's still going to owe me, you know, a small amount. But, you know, yeah, that's how I did that. So, yes, Matt.
Yeah, for anyone that may be on the fence with getting an accountant to run your business, do you have any idea of roughly what that would have saved me the first year of doing business?
I know it was probably $5,000 or $6,000, probably something. I don't. Yeah, that would be my guess, but you know, it could have been. I would have to run the numbers, you know, again.
Just starting out as a new business owner, I was like, well, it can't be that hard. to it. But paying John definitely was a favor in mine.
Yeah.
Like it was
Yeah.
in the green, definitely.
Mm-hmm. Yeah.
So for anyone out there, that's just an encouragement.
Yep. Yes.
So even though I filed taxes as an individual, as a sole prop and an LLC, they're filed under my social security number. I still need to do
If it's an LLC, you need to file the FinCEN, yes.
even though it's tied to my social security number on my taxes.
Is it sole prop?
Well, it's sole prop and I have two businesses.
Okay, so the sole prop is questionable. I don't think the sole prop needs to be done. I've heard both ways, but the LLC would have to be done, even if it's a single member LLC.
And the LLC, I think, is on Schedule C, right?
Yes.
So both of them are in my personal taxes.
So both of them are in your personal taxes, yes. But they still, the one is an LLC. The LLC is registered with the state of Pennsylvania. And because it's registered with the state of Pennsylvania, it needs to be filed through FinCEN. Yes. Mm-hmm. Yes, Eli. If there's been no transactions since 2020, that would become an exempt. Then it is exempt. Or under $1,000 since 2020 or something like that. Yeah, those are exempt from the FinCEN. Yep. Yes.
What if a property is an LLC? If it's titled to an LLC?
Okay, so the question is, what if a property is titled to an LLC? Does that require the FinCEN filing? It is, if a property is filed as an LLC, the LLC is considered a business, yes. And that would then constitute the filing of the FinCEN BOI report, yes.
Can we do one more question? And I would love to ask one final question. Anybody else got one more question? Daniel.
What?
Talk to me about different tax rates for different things. So just for an example, our Florida house, right?
Mm-hmm.
So we paid $1 million for it, put some work into it, took what, 350,000 of depreciation on it, sold it 2 years later for $1.4 million. So there's different types of gains there, right?
Yes.
There's the about 200,000 in actual gains, but there's also the 350,000 in depreciation recapture. So there, the solution's pretty simple, right? We do a 1031 exchange, but if we didn't do that, what are the tax implications?
Well, you would have to, your taxable income, your ordinary income would be raised by the 350,000. And so then
And the 350,000, but it gets taxed at the rate of depreciation recapture rate.
not the well, depreciation recapture is the same as ordinary income.
Okay.
It's the same rate as ordinary income. And so that would have gotten taxed as ordinary income. The other 200,000 or whatever would be capital gains, tax at capital gains rates.
And since it's over a year's worth of ownership there, it would be whatever.
It would be long-term.
We'd probably get it down to 15%.
Yeah, where long-term capital gains, the first 88,000 is taxed at 0, and then the remaining is taxed at either 15 or 20%.
Yeah.
Yeah, or first 88,000. Let me clarify that. The first 88,000 for a married filing joint couple. The first 44,000 for a single person. Yep.
On the example of Alvin's Airbnb in the basement, spending $60,000 on the beautiful outdoor space that I was enjoying just on Sunday evening, actually, was he able to? Did you take the whole amount as an expense, or was that a prorated amount based on use?
It was prorated. It was prorated based on use.
Okay.
Yes.
So you split it up to whatever percentage you deemed to be appropriate for the different uses, which
Yes.
was basically the Airbnb. And so you didn't take the whole thing.
I don't know. We did not take the whole thing.
Sure.
We took a portion of it.
Yeah. Yeah.
Mhm.
Good. Okay.
Yeah.
Well, we could keep going for a long time, but it's about time to wrap up. So how about a big hand for John? And I think John is going to do a real quick giveaway. Yeah.
Oh yes.
Yeah.
That's right. That's right.
So
So yeah. So the question is, how many of you bought your first home this year?
first rental property, right?
rental property.
First investment this year.
Anyone?
One. I see two hands. Are we missing anyone?
Yeah. I guess they both get a cup.
Okay.
This is my son. This is my son. He can have one anytime.
Well, that's up. That's your call.
Yeah.
You can come on up. Come on up. Or Scott, do you want to deliver it to him? Okay.
Yeah. And then whose birthday is the closest to today? Anyone have a birthday this week? This week? Birthday this week? Last Sunday? Or this coming Sunday? Last Sunday? Anyone else? Anyone closer than that?
You give it all to your brothers and your sons here, John.
I'll just give it all to we'll just give it all to family. Anyone that had a birthday has a birthday next week? Birthday next week? What day? What day next week? I think August 11th, 14th. Did he get one? Did he get one already? Steve, give it to Steve. And then I think we have one last one. Oh, there's two more. Oh, Ben didn't want one. Okay. What else? What else can we do, Jake? What else can we do? Any first timers here? Maybe we could do like a showdown between the first timers or something. Is there any first timers here tonight for the first time?
We got a good handful for the first time.
We got four. We got four. Well, I was thinking I have 2 books that I want to give away too. So I would have 4 prizes.
So the first
You go
four.
first.
The first
You go
four.
first. No, there's 4. There's 4 that were here tonight for the first time.
Okay. Okay. You got it. Yep.
Yeah. So you can pick. You can pick and choose. If you're a reader, one of the things I follow Tom Wheelwright pretty closely, and he has the Tax-Free Wealth book and the Win-Win Wealth Strategy. So this is the first one he wrote. I like this one. This one might be a little bit easier to read. So, you know, yeah. There you go. And then I think we have one more. First timer. Oh, wait. Do we have 2 more? Wait, I'm going to be in trouble now. There you go. Sorry. I thought we had 4. So I guess once we start giving out prizes, everybody was here for the first time, right?
It's easy to miss a few hands.
Yeah.
So.
Sorry about that.
Okay.
Yeah.
I think we're good. Again, how about a big hand for John? Most of you know, some of you might not know, but to put something like this together takes a lot of time and effort. So John put a lot of time and effort into getting ready for this. And as you could tell, the field is incredibly broad. So many things that we could talk about.
I do have one more thing.
Yes.
This isn't really good, but you know, I had the presentation here. We are currently not taking on any new clients. I'm sorry.
What a sales pitch. What a sales pitch. Currently not taking on any new clients.
I'm sorry.
But the fact is, somebody out there is. And I enjoy working with John. I think it's probably a little bit of an advantage that he lives 25 minutes from my house, but I would not be limited by that. You do not have to be limited to someone that's in Lancaster County or in Pennsylvania. Find someone that's a good fit for you and pay him what a professional needs to be paid to do what you need to get done with your taxes. Couple closing comments here. So for those of you that are used to coming on a regular basis, you know that it's actually not rare, but it's a little bit uncommon that we do such a deep dive specifically into businesses, business practices, stuff like that. We tend to mix it up pretty good. And I like bringing speakers in, a broad range of speakers, some that will cover more maybe business principles, even on the spiritual side of things. I think that can be very helpful. So next month, we have a fellow by the name of Rob Stoppard that's going to be speaking. He's a speaker, author, and a business coach, and he is with us tonight, and he's going to come on up, Rob, and tell us a little bit about what you're going to be talking about at the September meeting.
Thank you, Jake. Well, next month we're going to do a deep dive into the wisdom of God and how you apply it to your business. You know, we know in part and see in part, right? And a lot of times we just don't know what to do. But I wrote a book called Walking in Divine Wisdom just this year, or last year actually, And I learned a lot about what it means. How do you access the wisdom of God? How do you activate the promises of God so that you can accelerate in business? Does that sound good? Sounds great. Okay. Well, some of you sound like you like it, but not so sure, right? So we will talk about business. Now, my background is I spent 18 years in construction. I built a lot of houses, did a lot of remodel work, so I do know the industry, at least from that perspective. I've been coaching and consulting for 25 years. And I have one IRS story. One day I got a letter from the IRS, and it stunned me because I didn't know I had a tax I didn't pay. So the tax was around $5,000 or roughly, but with all the interest and penalties, it was up to $7,500. I was still in construction, and one of my suppliers who sold me kitchen cabinets, we had a meal one night. He said, I don't know why, but I think I'm supposed to give you the profits I made on you when you were buying my cabinets. He wrote me a check for $5,000. I went 2 days later on a job site, and I was doing a remodel job for this guy. And he said, I really like what you're doing for me. It's a great job. Here's a check for $2,500. Now, my taxes, my wages were going to be impounded on Friday. This was on a Monday when I got the notification. So by Thursday, I had the money. I went to Harrisburg, and I took the check in and got my taxes paid. I had enough money left over that I could take my wife out for dinner, so that worked out pretty good. So the IRS, to me, I've had numbers of not run-ins, but encounters, but I've never had a mean IRS agent like you hear about. So if you think they're mean, you're probably going to get a mean one. So I just want to leave you with that. But next month, we're going to explore a little bit what it's like to see the promises of God, the wisdom of God, enhance your business practices.
Thank you, Rob. Looking forward to that. If you want to get a jump on reading that book, I think you'll probably bring some along next month, but if you want to read it before Rob speaks, you can find it on Amazon. It's called Walking in Divine Wisdom, Timeless Insights for Troubling Times. Rob gave me one of his books, and I am partway through it. So thanks for that, Rob. Looking forward to having you here next month. With that, we're going to wrap it up, and I think that's it. So we'll see you back here the first Wednesday evening in September.